Mayuresh Joshi from Angel Broking is with us. And Mayuresh, just wanted you to comment on some of these high beta stocks. Would you say the kind of volatility and excruciating one at that, it's best to completely avoid this entire cluster for the time being?
Oh, absolutely, Ayesha. Good afternoon. A large element on all the news items that are probably surrounding all these stocks, the hammering that they received, the clarifications that come through, and the rebound in stock prices. Again, I think very, very volatile. So yes, as a pack, I think would largely stay away from it.
Right, and what's the outlook coming in on the kind of earnings as well that we've seen so far? You just had Ambuja Cements that put out its numbers. It came in a little bit below what we on the street were expecting. How have you looked at the earnings, Mayuresh?
Afternoon, Avan. A large element in terms of volume growth expectations, a tad bit below what we were expecting. Again, I think the large element that one really needs to look at with power and fuel costs and freight costs actually moving higher, there was going to be an impact in terms of the EBITDA performance, but the margins have held out pretty well. So large element in terms of their operations, specifically out of Western India, should have held in good stead for the over consolidated numbers for Ambuja Cements. When it comes to the future outlook, I think we need to hear the call in terms of what the management outlook is, specifically in terms of volume growth, the pricing trends thereof, and as the expectations of demand catch-up happen for this sector, with government spending happening on rural housing, which accounts for 33% of the cement offtake, along with infrastructure and urban affordable housing as well, we're largely going to see the element post-monsoons of volume growth picking up, reflecting in the realization pickup as well. So I think the management commentary will do the trick in terms of the future outlook for these stocks. But on an EV to ton basis, I think still, even if UltraTech is expensive at these levels, I think there is a lot of growth that can actually come through on their balance sheet. So from the large cap names, obviously UltraTech is something that we still continue to prefer and be optimistic about. Ambuja again is a hold, but I think we need to hear the management transcript to probably revise our ratings either way.
Mayuresh, it's been ever so choppy and volatile and pretty much the story for all time when it comes to the sugar space. The latest development that we picked up from the GST meet as well was that the sugar cess has been deferred, and they say the concerned GST's fundamental principle has been violated. So nothing really conclusive on that front. How have you read into this development, and what exactly does this mean for some of the companies and the farmers as well?
So large element in what the Exchequer was mentioning is that the cost of production is significantly higher than the realizations that sugar companies are deriving at this point of time. The second element in terms of the sugar cycle, it's always a 2-year on-off cycle. So we're clearly into an off cycle with SAP prices, FRP prices actually at elevated levels, indicating that the cane arrears that the mills need to pay out the farmers well in excess of 20,000 odd crores already. What you're seeing in terms of production numbers, 31 million hot tons already produced for this sugar crushing season. And again, the demand dynamics at 24 and a half. And even if you account for certain export subsidies to come through, with the kind of supply in international sugar dynamics, along with the pricing that you've probably seen, you are going to incrementally get that hit for a lot of these sugar companies. So in no way are their cash flows going to improve. The kind of announcements done in terms of a subsidy per ton of 55 odd rupees, that hardly offsets any concerns that the sugar companies would have. And again, I think the cess element that one was really expecting for to come through, I think any developments on that front will have a marginal effect. So I think it's a clear off cycle for sugar companies, at least over the next few quarters, and that will play out on their earnings as well. So I think we probably saw for sugar companies a few quarters back, and the kind of decline that we've probably seen, I think it is very well justified. So I think would stay largely away from the sugar.
Mayuresh, how do you approach IT now? And would you say that the best perhaps for IT is behind us, both in terms of earnings visibility as well as, of course, the way the stock prices have given returns in the last year?
So Ayesha, in terms of price movement, yes, I would agree that there has been a huge spike for a lot of IT companies, whether large cap names or the mid cap universe in general. But to a certain extent, the management commentaries, say for an example TCS, I think extremely encouraging. And though one might argue that valuations probably stack up against it, I think it gives you a sufficient amount of ammunition in terms of its key verticals actually doing well. So insurance bouncing back, digital again forming 23% of overall revenues. That does augur well for the stock. In terms of the commentary given by a lot of other players, obviously the organic growth commentary given by HCL Tech did disappoint the street, and to a large extent again the kind of expectations that one really has specifically from its IMS and a sharp improvement in the engineering vertical is something that the street will want to see. The second element also is that you're probably typically entering into Q1, Q2 where there is going to be a series of wage hikes, and that incrementally is going to take a toll on your EBIT margins, though the tailwind does appear in forms of the rupee depreciation against the dollar, which obviously abets and aids their earnings momentum. So I think the transformational deal wins on the digital front for a lot of these companies have been encouraging. What BFSI does, I think, is going to be the game changer or the kind of alpha creator for these stocks in terms of new order wins and probably sustenance of margins going ahead, as well as utilization levels actually staying afloat for a lot of these companies. The mid-cap IT pack selectively again has probably delivered better numbers in my opinion. So I think companies like Mindtree, where the double-digit volume growth along with pricing is expected to sustain, and again dollar revenue is expected to remain extremely strong. Cyient has given a very, very strong revenue guidance, specifically on its services part of the business along with the DFM business, expected to go at 20-odd%. What we probably saw with NIT Tech's numbers as well today, I think numbers were pretty encouraging in terms of the order book of $145 million odd. But again, I think the execution and BFSI is something that will determine the trends going forward, as well as valuations after the sharp run-up that we've seen. So again, I think TCS, again, long-term favorite, clear hold from our side. Tech Mahindra is a clear hold within the mid-caps. Mindtree, Cyient is something that I've liked at lower level, discussed this on your channel, but the run-up has been sharp, so one really needs to wait for declines. I think one really needs to wait for declines, Aisha, for IT companies, and you will get those declines if the markets remain volatile. So wait for declines, wait for the PE valuations to probably cool off, and then enter the stocks in a staggered way.
Okay, I just want to check in on what the aviation names are up to, and especially after Interglobe's disastrous performance, you've seen that rub off on a Jet Airways, or for that matter even a SpiceJet, and we've seen the kind of excruciating pain especially on both the Jet as well as Interglobe Aviation in the last two trading sessions. Indigo down another 2% in trade today, and I guess that would be the same state for Jet as well. Yes, much on expected lines, about 1.5% lower. Mayuresh, after Interglobe's numbers, would you say that perhaps is pretty much the trend that we are bound to see from even a SpiceJet, or for that matter a Jet? Because on one hand, crude prices are spiraling up, they're not really able to increase fare prices. So in that sense, they haven't been able to pass through the price increase or cost increases onto the customers.
Oh, absolutely, Aisha, and it's a classic dichotomy. So what you're probably talking about in terms of the cost per available seat kilometer, including fuel, with ATF prices going off the roof, you're probably seeing that element getting hit on the EBITDA front. At the same time, I think the pricing pressures have ensured that the average revenue per seat kilometer does not increase significantly, and as a result, I think the overall yields have shrunk for these companies. Now let's be clear that almost 27-28% is fuel cost, which is outside the control of aviation companies, with crude spiking up and the rupee depreciating. I think it's not helping or aiding companies in terms of their input cost inflation being curtailed. At the same time, I think the other elements like sale and leaseback, employee costs, depreciation, regulatory charges, airport charges eat into their operating cash flows. The third element obviously is going to be load factors, which are very, very encouraging at this point of time with a lot of local routes opening up. Gives it the sign that load factors and the available seat kilometers will improve. But again, a large element in terms of reported numbers with rupee depreciating and a cost that is calculated in dollar terms specifically, I think that does eat into their margins as well. So again, I think there are volatile times, but you're probably entering the strongest season. So I think the summer season is somewhere where a lot of these companies will report good numbers. So again, I think the kind of issues that Indigo had, the kind of cost optimization efforts that Jet is going through, SpiceJet has its own set of problems in terms of reported numbers. So I think being very, very selective at this point of time, any sharp decline on a counter like SpiceJet is what I look at, but one really needs to wait for decline because the volatility will eat into their earnings in the next few quarters as well. So wait for sharp declines on counters like a SpiceJet before you enter.
guests as well for some closing comments. And Mayuresh, how would you sum up the week gone by? And next week, it's back to the grind in terms of earnings. ICICI Bank, Eicher Motors, Asian Paints, Titan, those are just the frontliners all set to report their numbers.
Oh, absolutely. I think it's a very result-heavy week, the coming week, and what largely will determine is that they are market leaders in their respective spaces. So again, I think their performance, outperformance or underperformance will determine the tone and the direction of not just their sector, but the markets as well from an immediate perspective. But our own sense is that the markets probably are stuck in a range. Unless you get a definite clarity in terms of the overall earnings picture over the next few weeks, it is very difficult to project how the earnings season will actually pan out. So even if one excludes PSU banks and the oil and gas names, earnings in our opinion should be quite reasonable in this quarter, and that itself should give a path in terms of a strong earnings rebound over the next few quarters. So again, time and again, as I've been mentioning, I think with expectations of government front-loading their capex program, expectations of normal monsoon coming through, the second half is going to be critical. But again, the second half is already jam-packed with a lot of political events. So I think it's a lot of sum of moving parts, along with crude and the interest rate curve on the global side, not helping things either. So I think it's a range that we've probably defined ourselves with maybe 10-100, 10-200 on the lower side, 10-650, 10-700 on the higher side of the range. But again, I think expecting some amount of weakness to come through over the next few weeks as the Karnataka outcome probably draws closer. And then probably I think would be a good time, in my opinion, to probably look at qualitative names within the large cap universe or the mid cap universe and start nibbling into in a staggered way.